Hey everyone, this is Nate Crosby from Crosby Advisory Group. Wanted to put out a short message here about an idea that's maybe a little bit outside of the box in terms of asset allocation, but it's perfect for September, which is National Life Insurance Awareness Month. So if you look at your 401k, a lot of times when you build this 401k, the choices that you have to build it are different types of asset classes. You might have large cap stocks, small cap stocks, mid cap stocks, bond funds. When you look at that, your choices are stocks and bonds, any way you look at that. Bonds have traditionally served as the rock or the stable portion of the portfolio. And as an investor ages, that bond position traditionally has gotten bigger because that limits the volatility in the account and we're preparing the account for retirement. But what has happened to bond funds in the past couple of years? Take a look at the Vanguard Total Bond Market, or if you look at the iShares Long Duration Treasuries, all of these sold off very, very aggressively as interest rates began to rise. So all of a sudden an investor looked around and said, hey, this stable part of my portfolio, these bonds, were anything but stable during that period of time. As a matter of fact, if you look at the Vanguard Total Bond Market, in 2007, you could have bought a share for roughly $71 a share. In 2023, you could have bought a share for about $69. Over that period of time, I realize the fund has paid interest over that time. But if you held that outside of an IRA or outside of a 401k, you also pay tax on that as well. So you could have had a situation where over a long stretch from 2007 to 2023, the value of your bond fund, your Vanguard Total Bond Market, actually went down and you were taxed along the way. So what do you do? What if an investor says, hey, I like this idea of having this stable portion of my account, but the bond funds aren't doing it for me? I've got something for you to consider, especially if you have dependents. What about replacing that bond fund with cash value life insurance, particularly participating whole life insurance? What would that achieve? Number one, we've got predictable, stable growth that would mimic what a bond fund should provide in the sense of that 3 to 4% return. The benefit of the cash value life insurance is it grows without being taxed. I can hold that outside of an IRA. I can maintain access to it. I can reach that cash value at any point in time, which is not the case in a 401k or an IRA, but it's growing deferred without being taxed. A participating whole life policy will pay dividends. If I wanted to receive those dividends are considered return of premium, therefore they are not taxed. So I can actually receive dividends from that whole life policy without being taxed. There are ways in which I can access that cash value without being taxed. I can actually take a loan from the policy, not physically pull it out or surrender it. I can take a loan from my policy, and it's the only financial investment out there where I do not disrupt the future growth of the policy. Let me explain that. If I have $25,000 sitting in a mutual fund and I pull $20,000 out to go put a down payment on a car or buy a car, I disrupt the growth of that mutual fund because that $20,000 is no longer in that account. With a participating whole life policy, I can borrow that money to make the down payment on the car, and it treats the dividends and the interest as if that money never left. So it doesn't disrupt that. I'm able to put that money back when I want to. I don't have to put it back. But the key is I have achieved predictable, stable growth. It's non-correlated. It's not in the stock market. As the stock market goes through its fits and recessions, that whole life policy, assuming I'm putting it with a reputable company, is high and dry and should continue to grow every year. It's grown without being taxed. But the number one thing about that also is, what other investment can I take pennies and leverage to dollars as far as a death benefit? If I pass my 401k or a mutual fund onto my spouse, all I can pass to her is what I've been able to accumulate it. But with the life insurance policy, I've got that death benefit on there as well, right? So I can pass many, many times what I've accumulated in this account onto my spouse or family or charity or beneficiary of your choice, and they receive that tax-free. So something to consider. A lot of people say, I want 20, 30, 40% of my portfolio in something stable. Well, what if some of that is in cash value life insurance? Kill two birds with one stone. A life insurance product is fantastic because it's the only product that I know of that is self-completing. What do I mean by that? Well, if I'm 30 years old, 40 years old, 50 years old, and I don't achieve normal life expectancy, well, my family has been cut short the income that I would have received had I lived a long, full life. The life insurance policy ensures that nest egg is reality. Whether I'm there or not, that nest egg is going to be reality. So fantastic product, often overlooked, especially when we're comparing the performance to a bond fund or fixed income. Cash value life insurance, in my opinion, is something that not everyone, but some people should consider. Remember, you have to qualify for it. So not everybody's going to be able to get it. But for those who do, I think there's a place in the portfolio. I'm Nate Crosby. Thank you for this moment and taking the time to listen to this video, and I hope you have a great day.